Hey everyone, in today's video, I'm going to be talking about 4 dividend stocks that I'm planning on buying throughout the month of August 2023. We'll jump right into it, but if you just have a minute to just smash the like button, it would really help with the YouTube algorithm. So just take a second to do that. The first dividend stock that we'll be talking about today is Fortis. Fortis is a dividend stock that I already own here. Just doing a bit of a recap of how the stock's been doing. It's about flat year to date, just up 1%. In the last year, it's actually down 7%. This is a regulated utility company that operates in Canada, the US, as well as the Caribbean. So it's a pretty stable cash flow provider, dividend payer, starting with a 4% dividend yield here. It's dipped mostly with the broader regulated utility sector as a byproduct of interest rates going up recently, but I think it's in a good spot for me to add for the long term. Like it says here, you get a starting yield of 4%, but we're going to talk about this company a bit more here. Just looking at some of the elements of the business, you can kind of see some of the markets that they support here down in the Cayman Islands, Belize, Turks and Caicos, some key markets in the US, whether it's Arizona or the northeast part of the country, Ontario, Alberta, British Columbia, and then out east in Canada as well. So you get some geographical diversification just from the places that they are passing electricity and utilities. You also get a good sense on the left-hand side here in terms of their asset mix here and exactly what kinds of businesses they're in. You see the 10-year total shareholder return here, 9.5%. It's a pretty stable company. This isn't a company that's going to go up 50% in a year. Also unlikely this is a company that's going to go down overly huge in 1 year as well. And they have really consistent dividend growth too behind their regulated utility model. Looking at their plan for growth here, you can kind of see they're expected to increase their rate base on lots of their existing assets. They have inflation adjustments in their contracts and other growth levers in their contracts. And then they also have a really heavy investment plan. So this is a company that's continuing to build out more assets and additional revenue streams within utilities and especially regulated utilities, whether that's distribution assets, clean energy assets, or transmission assets. They specifically talk a lot about their clean energy projects from like an ESG perspective. So they're trying to be like an industry leader on that front, making sure that in the future, as governments and municipalities may require or be more lenient or provide higher rates to companies providing clean energy, they're making sure they're investing there to future-proof the business as well. And then with that boring stream of regulated utilities income comes really strong and consistent dividend growth. You see here, we're about to hit the 50th consecutive year of dividend growth this year. They tend to grow the dividend about 6% a year over the last 10 years. I've held this stock for probably 6 years or so now, if not longer. And that's usually what I get, a mid-single digit dividend increase every year, which for a company that's paying out a 4% dividend to start with is not too bad. You know, you're getting a decent starting dividend, and then you're also getting a tiny bit of growth layered in. And you'll see that here, the 49 consecutive years, 4 to 6% range. So pretty good on that front. Just trying to show a couple more pieces of data here as well. You get a sense for their mix of geography. I know I showed it on the chart before, but this one you actually get the percentages. You got 20% there on the energy side, 20% in BC, 10% in Alberta, 8% in Central Hudson, which is New York. I think lots of Manhattan there as well. Eastern Canada, so more Prince Edward Island, etc. Just a small part of the mix. Caribbean, a couple percent, etc. So they're really well spread out, at least across the US, Canada, and then a bit in the Caribbean as well. So you're getting regulated utilities, you're getting good diversification, getting a good dividend starting yield, 4%, which is a percent payout every single quarter, and then you're also getting some dividend growth. So this isn't one you're probably going to get rich off of in the short term, but I think it's a really stable dividend provider that should fuel my portfolio for years to come. And that's why it's one that on a 7% dip on a 1-year basis, it's on my watch list. Not on my watch list, it's in my portfolio already, but on my watch list for stocks I'm looking to buy more of in August of 2023. Also, what makes me sleep good at night is just over the last 20, 25 years, you can see the stock's pretty much up tenfold or eightfold from that point. So they've really been able to create a lot of shareholder value on the shares as well as the dividend growth. So I believe in the company's ability to continue to do that long term, and it's very rare to get them down 5-10% over a long period of time. So I feel like eventually they'll get it together, they'll break out. As interest rates go down, the valuation should go up naturally given the type of assets and consistent dividend and profits that they spin out. So stock number one that I'm really looking at buying in August is Fortis. Stock number two is Jamieson. Jamieson Wellness, for those who don't know, is primarily a consumer packaged goods company. They sell a lot of vitamins and proteins and over-the-counter products like that. Looking at their stock really quickly here, they're trading about $30 a share, down 15% in the last year, but their fundamental performance has been really well. This stock really popped during COVID, went all the way up to $44 a share. Now it is down at about 30, so a pretty big dip, but the performance of the company has actually held pretty well. They increase the dividend every year, starting at 2.2% here, and their earnings per share estimate for this year is, I believe, about $1.70. So this stock is trading about 18 times earnings. Unlike other CPG companies like Coca-Cola or Pepsi, this company is riding a health trend that has a lot of room left on it, yet they're trading at a much lower multiple than some of these other companies who are more impacted or more tied into unhealthy habits, unhealthy eating, and stuff like that. So it'll be really interesting to see from a PE standpoint how much upside room the company has. But I think aside from the PE, they also have a lot of great growth opportunities. This is just overlooking the revenue that this company has delivered here. So you can kind of see here, 2015, they're doing a couple $100 million. That doubled by 2020 to 400. And in 2023, they're looking at 700. They did make a meaningful acquisition into the US, which I'll talk about in a minute. But I think that's partially fueling that 700 from 2020 to 2023. Long term, though, the company's really provided strong CAGRs, about 13% since they went public 5 or 6 years ago, over 11% over in the last decade. So this is a company trading 18 times earnings, but they've been able to grow double digits consistently over the last decade, year in and year out. Looking at some of their cash flows here on the left-hand side, you can see how strong they've been growing. Consistent growth, 33 to 50 to 60 to 70 to almost 80 in cash flow from the business. And then that comes with increasing dividends. So the dividend from 2018 has more than doubled to today. So you look today, they have that 2.2, 2.3% yield. If they're able to continue extrapolating that dividend growth at that rate, by the end of the decade, you'll have a yield on cost of close to 5%. So also could be a pretty nice dividend growth play if you believe in the underlying company here. At the end of the day, this is a $1.2 billion company, and their goal is to reach $1 billion in net revenue over the medium term. You saw on the first chart, they're currently at 670 to 700 million. So this represents about 40% upside to the current business. Looking at areas that they're planning on doing that, and this is really where they operate today. They primarily operate in Canada. We'll look at that in a second. They've been expanding in China. They just made an inorganic acquisition in the US to propel their growth there. And then they have distributors internationally. So through these 4 vectors, they're trying to get to $1 billion in share. The first one, which I think is probably the biggest opportunity for the company, and after their home market of Canada and making sure the business is healthy there, where I'd like them to be focusing the most on, is in the US. So they have a $40 billion market opportunity in terms of the size of the overall VMS market there. And they're hoping to grow their business double digits, so 11 to, let's call it 20% next year. You see here in 2022, they did 68 million. 2023, with the acquisition that they made, it's going to be about 150 million. So from 2023 onwards, being able to grow about 10% a year is an additional 15 million in revenue on the business that hopefully they can continue to deliver on. Some opportunities is bringing in the Jamieson brand into the US. Right now, they acquired U-Theory, which is a premium VMS brand, primarily playing on the west side of the United States in California. Some other things that they call out here, channel expansion. So playing in more channels, whether that's convenience stores, dollar stores, whatever, wherever their outages are. I'm not too close to the specifics on that. International opportunities. And then I feel like leveraging Jamieson's innovation and just synergies between U-Theory and Jamieson in terms of distribution opportunities, R&D opportunities on the back end could provide a lot of opportunities to break into the U.S. market in a much bigger way than $150 million. Then going to the next one here, I believe this one here is it China? Yes, I think this one here is China. So showing how they have a very high growth target here, currently at 28.5 million, but that was over 20. So that's like 35% growth. This year up to 50 million. Tons of opportunities here in China. Their focus here, they outline, is to continue e-commerce, continue club distribution, try to continue to build the brand as the most trusted wellness brand in China. So lots of opportunity here, lots of work here. I think it makes sense to focus here given the size of the market, but I still think that the U.S. is probably a higher priority in the grand scheme of things, even though it's a newer market that they just recently entered. Canada, for the short term here, until they really build out China and build out the U.S., this is really where the money is made and the cash flows derive from. So much more developed market, despite being 1/10 the size of the market or 1/20th the size of the market as the U.S., the business is still over 2 times bigger here, given it's the home market. More developed market here, so you have more modest growth, 3 to 6%. I think if they're able to, play in that 4 or 5% range, that would be good for the company to continue to make more money in Canada, fuel more growth in China and the U.S. with that money, and not decelerate the growth of the overall company too much, even though I don't think it's trading at a necessarily rich valuation. And then international expansion in terms of licensed partners in Europe and other countries. I'm a bit less focused on this. I think it's good to do, good to get the brand out to more places. Hopefully they can make more and more money here in regions like Eastern Europe, Middle East, Southeast Asia. But I think they have so much opportunity in the US and China, and then continuing to make sure the business is healthy in Canada, that this is really secondary in nature in terms of priority in my eyes. But that's kind of the 4 pillars of where they're going to go from $700 million to $1 billion after 2023 on the business. Looking at 2023 guidance, this is a bit misleading given the acquisition in the US, but they are expecting to grow top line 20 to 30% there. If you look by region, U-Theory, they're not really giving growth rates since they didn't own the brand in the base. China continues to grow pretty strong. International slowing down a bit, but you're still getting some growth. So consistent growth across the board. Diluted EPS sitting at about $1.70 there. So still growing EPS, high single digits, let's call it, in the middle there. So it's just interesting to see a company that is probably on a broader health trend than lots of the other CPG companies, growing historically double digits, still forecasting for high single digit EPS growth, trading at 18 times, where other companies with probably less fundamental advantages are trading 25 to 30 times. So that's one of the reasons why I'm investing in this company in August. I just feel like it's probably a bit too valued to begin with, given how the company's doing. And I think long-term wellness will continue to be a bigger trend. So happy to invest in it now. I think this stock will go up at least a bit, and I can make a bit of money off of it, in my opinion, for my portfolio. The third stock that I'll be buying more of this month is Realty Income Corp. This is a stock that I started buying a few months ago, built up a position of about 140 shares, trying to get it higher, whether that's 150 or 200, we'll see. But this company's crashed with lots of the other retail REITs and REITs in general over the last year, down 17% past 1 year. But this is really a fantastic REIT and owns fantastic assets. Just looking at their portfolio here, I've showed this slide a couple times, so I'll go through it quick, but I love the diversification. You'll see it on another slide too, but they're in every single US state. They have really great tenants, triple net leases, so not too complicated to manage. Just need to make sure they're getting the right tenants in, then after that the money comes in like clockwork, pays out a 5% dividend to shareholders. So all in all, I think this is just a great diversification play in my REIT portfolio, within my broader stock portfolio, to have some US assets paying me dividends on a monthly basis. Also like how they've been diversifying even out of retail, buying experiential assets like the Wynn Boston, that they're getting about 3% of their rent from, and some other vectors of growth they're pursuing, like strategic partnerships and strategic acquisitions in certain segments. There's one of them right here, acquired a $500 million dentist portfolio in 2022. So this is one area of retail that is relatively defensive, can't really take dentists offline from Amazon or anything like that. So really good place to play, and should be paying dividends literally and figuratively for a long time into the future, with those types of acquisitions and positioning of the portfolio. A couple other ones here. They got into a strategic partnership with a farming operator. So just kind of shows how, aside from just your corner stores, your Dollar Generals, your grocery stores, how they're looking at continuing to expand the scale of their operation and partnering with very defensive type businesses in their portfolio for future growth. Another area that they are growing quickly in terms of their focus and their investments are in Europe. So they are in Italy, they're in the UK, they're in Spain as well. A couple sound bites here just in terms of why these are attractive geographies and the benefits of scale in these markets. But overall, I just think this adds an additional layer of diversification. You can see here the overall European portfolio. They have almost 300 properties now, so they've really built this out. Tons of years left on the average rents, or the average leases rather, almost 10 years. And you can see here how much they've been investing on a quarterly basis. So pretty heavily, it's a pretty big focus area for the company. And I like getting that exposure too in my portfolio. I like, how they're heavy in the US, but I think this is a nice little sweetener as well. So I view Realty Income as a relatively safe company. All REITs have their pros and cons in terms of how they move and how interest rate sensitive they are and sensitive to the macro economy. But I think Realty Income, out of the options that there are in the US, really well positioned, gives me a nice starting yield of about 5%, and they tend to increase their dividend year in, year out. So glad to buy more of this one this month as well in my portfolio. And lastly, this one is also a dividend stock, but a bit more of a growth stock, so a bit of a tricky one to add in here, but they're paying about a 0.76% dividend. It is Visa. Visa is a payment processing company. They just have a bunch of networks that coincide between the banks, with consumers, with merchants, etc. Looking at this company past 5 years, you can see it up 70%. And they just have a history of really just breaking out in a big way. And I feel like, given the fundamentals of the business, given the performance of the company, given the runway for cash to card transactions all over the world, they're just due for another breakup here soon as well, or breakout rather. Looking at their business, they grew revenues, net income, EPS, etc., all by double digits here on Q3. looking at Q3 here, they did over $8 billion in net revenues, and then about 4.5 in net income. So after they paid their taxes, they made $4.5 billion on $8 billion in net income back to the investor. That is incredible margins. Just goes to show how lean, capital light this business is. And that's one thing I really like, is they continue to effectively scale top line. It's almost all falling straight to the bottom line for this company. This is just another way to show that they have had almost $14 billion of net cash from operations year to date, and they've paid under $1 billion in CapEx. So their CapEx rate on that is about 5% of the total company, or the total cash being brought in. So very efficient. What do they do with this money? You see here at the bottom, they've bought back over $8 billion of shares. So bought about 2% of the company back just this year so far to date. And then they also pay that small dividend. You can see here, based off of the ratio between share repurchases and dividends, this company has more room to pay higher dividends. And I think they will continue to grow their dividend at minimum double digit a year, if not closer to 20% annualized, with how fast their EPS, their free cash flows are growing, paired with their stock buyback. But this is just one of my favorite companies. Such a good business model. They essentially have a royalty on the global economy. As people travel more, they make more money off of FX fees. As people just buy more things, and as inflation occurs around the world, they're getting percentages on higher dollar amounts. So I think this is a pretty defensive company over the long run, as long as the economy doesn't stay in a stint. And if the share price does go down, they have tons of free cash flow coming in no matter what the scenario, which they can just buy back the shares for cheaper, create more long-term value for shareholders. So I really do like Visa as a business here. Looking at their EPS, they're going to do just under $8 this year, just under $9 next year. So going back to the stock, trading at about 30 times current year earnings, and then closer to 26 times next year's earnings, 26, 27. So expensive company, but I think this is one of the best companies in the stock market from like a positioning point of view, history point of view, how well they've been able to execute, business model point of view, and just from a fundamental aspect. I think this company will continue to do really well. I think the only thing that can really slow them down is regulation. So we'll see what happens on that front. But this company's firing on all cylinders, and I want more of it in my portfolio. So there you have it. Those are the 4 stocks I'll be buying more of. Going through them quickly here. We've got Fortis, which is a more developed dividend payer with some dividend growth layered on. You got Jamieson, which is still in growth mode, bit of a lower starting yield, but bit of a faster grower, bit of a riskier play overall. Realty income, similar to Fortis, really reliable, developed company, paying a 5% starting dividend yield and some slight dividend growth. Probably won't get the same rate of growth as Fortis, despite getting that 1% higher starting yield. And lastly, Visa. Visa is essentially my growth stock of the month that I want to add to a bit here. But it is not a high dividend payer at the beginning. So it's definitely a longer term build on my yield on cost. If you like this type of content, I will link my video that I did earlier in this year to why Visa is the stock I'm buying in 2023 the most, which I did at the beginning of January. That was when the stock was about $200 a share. So I should have been buying more and more back then. But I still think it's at a fair valuation. I'll link that video in the description of this video. And if you just like this kind of content more broadly, be sure to like this video. It really does help smaller channels like me with the YouTube algorithm, gets these videos in front of more people. If you stayed till the end of this video, please let me know in the comments. Not too many people do, so would really appreciate to hear from you guys. Thank you guys, and I'll see you in the next